It's Brian Preston, the money guy.
So then the next question is, which is better, the avalanche or the snowball? How do you decide which one makes the most sense for you? And you kind of said it's very much an individual behavioral decision. And then does it even matter? Does it even make a difference? Or are they both good and you'll be in the same spot no matter which way you go?
Wait a minute. I smell it. I see a case study coming our way. And I bet Daniel has some great clip art because he gets so excited showing us his different clip art that he's put together. Let's look at what Daniel's created so we can kind of look at the details of the math of this.
So this is what we want to put together. We're going to look at two different debtors, and Daniel has called this a tale of two debtors. We've got Snowball Sam, who's going to do the debt snowball, and we have Avalanche Abigail. I love his naming.
What you don't know is Abigail had a cane the first time I saw this. And I was like, why does Abigail have a cane? He goes, oh, let me see if I can mix this up.
Oh, good. I'm glad he took her cane away and gave her a book. So obviously Sam is going to follow the snowball method, and he's going to prioritize the smallest debts first. He's going to look at the smallest balances and knock those out first. Abigail is going to pay off the debt with the highest interest rate first. So let's assume they both have the same debts. And let's assume that their debts are $5,000 from a local retailer, and the current interest rate on that is about 1.9%.
That sounds like a teaser rate.
That's a teaser rate is what it sounds like. Let's assume that their second is a $6,000 debt on a credit card. Ooh, but this one is at 19.99%, which is pretty scary when you think about how high that interest rate is. And then they have a third credit card where they owe $7,500, but this one's actually at 29.99%.
Now, here's what I think is interesting, and I know we'll come back to it. I didn't believe that there's actually 29.9%, but I'll let you prove me wrong in a minute.
And so let's say that they have a $200 extra per month that they can put towards paying their debt. You know, Snowball Sam is going to do the snowball, and Abigail Avalanche is going to do the avalanche. And we're going to see how they differ, how it comes out. Now, you did ask the question, Brian. Well, at 29,
I didn't believe it.
Average APR is somewhere between 17 and 18. 29 doesn't really exist. That's what you were saying pre-show, right?
I was like, think about this. Guys, every dollar you save and work, I get excited about, and you guys troll me when I talk about 20-somethings could potentially get 9 to 10% compounded growth.
Yep.
You guys were like, where is that? I've never seen that. Meanwhile, I find out there's a whole section of the population out there that's paying 30% per year to a credit card. They're having, we're leveraging out how much opportunity is being squandered here with high interest rates. So Daniel had to go show me, yes, this does indeed exist.
Yeah, so we actually went out and found two credit cards that currently have APRs of 29.99%. It also looks like they have monthly fees after the first year. So these are just not the ideal credit cards that you want to get. But you know what the good news is? You got cash back. 1 to 3% cash back. But these actually do exist out there. So one of the things you really want to check on is maybe the card that you're utilizing early on, if it does have an annual fee or it has a higher interest rate or there are other benefits it doesn't have, and maybe you've had it for the last 3, 4, 5, 6 years, now might not be a horrible time to revisit that. Theoretically, you should not care a ton about the interest rate because, remember, you're not going to carry a balance, but it's not uncommon for you to have better access to better credit cards later in life on your financial journey.
I also want to draw attention. This is something I don't like that the financial industry does. The worse you are with your money, the more they're going to penalize you.
That's exactly right.
So, because the only people that would be willing to pay a monthly fee on a credit card and then pay a 29.9% are obviously people who have struggled with good decision making with their personal finances. So this is going to just pile on top. You're going to layer, instead of good things happening for you financially, the army of dollar bills and compounding interest is actually against you.
Right.
So you need to quickly realize this is all going to come down to, how do you want to be viewed by the banks and others? Do you want to be a partner that they're trying to throw things your way so that you can be successful and win with low interest rates, low insurance rates, and other things? Or do you want to be that where they prey upon you, that predatory lending where they jack up your rates, they charge you all kind of fees? Be mindful. start trying to figure out, how do we build the deferred gratification? How do we get the discipline to live on less than we make so we never get in this type of situation?
So let's take a look and see how Sam and Abigail did. Remember, they're both going to pay $200 a month towards satisfying their debt. And Sam, who went with the snowball approach, would have ended up paying $29,806 in total, paying off all the debt plus all the interest that accrued, and it would have taken him about 5.6 years to get that paid off. Now, Abigail, on the other hand, who went with the avalanche method, paying the highest interest rate first and working her way to the lowest, well, she would have actually only paid $25,223 in total debt payment and interest, and she would have had it paid off in 4.7 years, almost a full year earlier than Sam.
So here's what I think is also interesting on this. Remember, the setup is they're paying the minimum plus the $200, and they had the same debts. So incrementally, these are the same dollars going in. It's not like we ignored one concept on another. This is incrementally $1 is the same as this dollar. It's just, how did they actually allocate the money? And I'm just shocked, because if you look at this, and there's a reason Abigail is basically doing a dance move,
dancing,
is because she gained a year that she actually was not under the thumb of the debtors, and then she also gained about 2/3 of what a Roth IRA contribution could be. So those two things together, man, it is powerful to understand where you are from a behavioral standpoint, so that you know, hey, look, I don't have to do this just to get the kudos. I'm going to do this because I'm good at math and I want to minimize the interest I'm paying.
Now, remember, neither one of these are ideal, because we really don't want to be in debt if we can avoid it. But it is interesting when you look at the breakdown by account. On the retailer, remember, they had a total balance of $5,000. Well, Abigail did pay more on that debt. She paid $219 in interest, where Sam only paid $71. And actually, Abigail paid more on the middle credit card as well. She paid almost $3,300 in interest on that one, where Sam only paid $2,400. So if you kind of stop the illustration there, you'd say, man, Sam paid a lot less interest than Abigail, because, those two, he was significantly lower. However, it's because that high interest rate on that large balance just kept gobbling and gobbling and gobbling and gobbling up interest for Sam, where he paid way more interest over the life of these debts than Abigail did.
I mean, having that 29.9% credit card is like having termites in your financial household, because you didn't see the damage that's going on in the silence, but it's munching away at your opportunity in future. And that's why I do think that this is, if you are the type of person that has high interest rates, guys, try to get on the discipline train to maximize getting those high interest debts paid off as soon as possible.
Now, we didn't show it here, but the real exciting thing is, you said this, Brian, Abigail saved almost what she'd be able to max out her Roth IRA with. Think about how powerful those dollars. What she was going to do, she could go to moneyguy.com/resources and go see, man, if I took that $4,583 of interest and I invested it today, 11 months sooner than Sam did, what could that turn into by the time I retire? And it gets powerful. While that might not seem like a huge amount of money early on, that $4,600 can be huge when you take it out 20, 30, even 40 years into the future.
Yeah, so I want to talk about what's the actionable steps here. How do people need to think about this? First of all, do you have credit card debt that you're not paying off monthly? If that's the case, I do think you have to go to extreme measures. I don't care if that means, I'm from Atlanta. There's a total consumer advocate that would literally advocate putting your credit cards in a glass of water, a cup of water. Like I guess you could say red Solo cup or something. Putting water in it, throw it in your freezer, so you're literally freezing physically your credit card so you don't have access to it. So then you turn this into, how do we get out of debt since you're not swiping anymore? I think that's the big thing. You've got to stop digging, because credit card debt is not a shovel. It is the biggest excavator of moving earth that you've ever seen, especially credit card debt. Like I said, 30% interest. There's no way you recover from that if you don't knock it out as fast as humanly possible. And that's the part. You have to figure out, do you need to celebrate small wins? If you do, maybe the debt snowball does work for you, but it probably does mean you're paying extra interest.
Yep.
Whereas if you're a financial mutant, you're a person that recognizes, I am changing my life. I am building for a better tomorrow for myself, that great, big, beautiful tomorrow by using deferred gratification today. You probably will like the debt avalanche method.
If you need some motivation, go out to the website, moneyguy.com/resources, click on our deliverable, how powerful are your dollars, and it will show you how much every dollar can be doing for you if it's in your army of dollar bills instead of working against you in debt. Debt should be a 4-letter word. It's okay to use it. It's okay to have a store retailer. It's okay to have a credit card. It's okay to have an auto loan, but you want to make sure if you are utilizing those tools, you're using them well and you're using them responsibly so that they can be tools for your wealth building journey, not tools to dig yourself into a hole that you can't get out of.
Well, I never know who's watching our videos. And in my mind, I like to think based upon the emails and the comments you guys post, some of you are brand new to personal financing. You are starting to recognize internally, maybe you are mutating a little bit and you want to do things better, but you don't come from a household. Because you know the stat I'm going to say. 80% of millionaires are first generation, meaning their parents weren't millionaires. So you might not know how to optimize what to do with your next dollar. And it's not like there's a lot of resources out there that say, do this with your next dollar. We've actually created it. If you go to moneyguy.com/resources, we do have the 9 steps of the financial order of operations. Money is no different than math. You will get math wrong over and over again if you don't understand, please excuse my dear Aunt Sally. I mean, because that's the thing. You have to know, do you do addition first? Do you do multiplication? Do you do the parentheses? You've got to know the direct order. Money is the same way, so make sure you understand the financial order of operations. We've laid it all out for you, and we want to accelerate your process in creating success.
Now, here's what happens. We hope that you'll show up. We hope that you will learn these concepts that we are sharing with you. We hope that you'll apply it to your financial situation. And once you do get out of the debt, we hope you'll continue to grow. We'll hope that your financial empire will continue to build. And when you get to the point where maybe you don't have enough time to keep an eye on your finances, or maybe the gravity of your financial decisions is just too great, you don't want to go at it alone, or maybe you just don't know what you don't know, you'll remember the team that planted those seeds and helped start you on the abundant cycle of building towards financial independence.
Yeah, I think that's a great invitation because, look, we don't ask for anything in return. It might be years in the future that you actually reach that abundant cycle moment, but we're going to be here. We're going to keep creating free, great content for you guys, keeping investing in you, and we're just so thankful for all that you provided us so we can keep loving on you and creating more and more success. I'm your host, Brian Preston. Mr. Bo Hansen, Money Guy Team, out.